Welcome to Business Studies for SS1 at Light Tech Academy. Today we study Public Limited Company, Shares and Dividends. What is a Public Limited Company, PLC? A Public Limited Company, PLC, is a company that is incorporated, registered, under 2020, has a separate legal entity, shareholders have limited liability, and, crucially, can offer ITS shares to the general public for purchase. Its shares can be listed and traded on the stock exchange. The name must end with Public Limited Company or PLC in Nigeria. Minimum requirements, 2020, Nigeria. Minimum 2 directors. Minimum share capital as prescribed by SEC, Securities and Exchange Commission. Minimum 3 shareholders, at least, though in practice most PLCs have hundreds or thousands. A company secretary. Key differences: Private Ltd versus Public PLC. Private Ltd, 1 to 50 shareholders, shares not offered to public, shares cannot be freely transferred without board approval, name ends Ltd. Public PLC, 3+ shareholders, unlimited, shares can be offered to the public, shares freely traded on the stock exchange, name ends PLC. Going public, flotation. When a company decides to sell shares to the public for the first time, it is called an initial public offering, an IPO, or flotation. Before an IPO, the company must 1. Meet the listing requirements of the Nigerian Exchange Group, NGX, formerly NSE, the Nigerian Stock Exchange. 2. Issue a prospectus, a legal document that provides detailed information about the company, financial statements, directors, risks, use of proceeds, to the investing public. The prospectus must be filed with and approved by the SEC. 3. Underwriters, usually investment banks, may underwrite the issue, guaranteeing to buy any unsold shares. Shares, equity. A share is a unit of ownership in a company. Each shareholder owns a fraction of the company proportional to the number of shares held. Types of shares. 1. Ordinary shares, equity shares. The most common type. Ordinary shareholders are the true owners of the company. They have voting rights at annual general meetings, AGMs. They receive dividends, but only after all other obligations are paid. Dividends on ordinary shares are not guaranteed and vary with profitability. In the event of winding up, liquidation, ordinary shareholders are last to be paid after all creditors and preference shareholders. They bear the highest risk but have the highest growth potential. 2. Preference shares. Shareholders receive a fixed rate of dividend before ordinary shareholders. Usually no voting rights, or restricted. In winding up, preference shareholders are paid before ordinary shareholders, but after creditors. Cumulative preference shares. If dividend is not paid in 1 year, it accumulates, and must be paid in a future year before ordinary shareholders receive anything. Non-cumulative preference shares, unpaid dividend is lost, does not accumulate. Convertible preference shares, can be converted into ordinary shares at a specified date. Redeemable preference shares, can be bought back, redeemed, by the company at a specified date. Participating preference shares, in addition to fixed dividend, also share in extra profits. Dividends. A dividend is a payment made by a company to ITS shareholders from its profits. Dividends are decided by the board of directors and approved by shareholders at the AGM. Types of dividends. 1. Interim dividend, paid during the financial year, before the final accounts are prepared, based on estimated profits. 2. Final dividend, paid at the end of the financial year, after the final accounts are prepared and profits are confirmed. Recommended by directors, approved at AGM. 3. Scrip dividend, bonus shares instead of cash, shareholders receive additional shares, bonus shares. Conserves company cash. 4. Property dividend, payment in assets rather than cash, rare. Dividend yield, a measure of the return on investment from dividends. Equals, dividend per share / market price per share, times 100. Share price versus par, nominal value. Par value, nominal value, the face value of a share as stated in the Memorandum of Association, e.g. 1 Nigerian naira per share. Market value, market price, the price at which the share is actually bought and sold on the stock exchange. Determined by supply and demand. May be much higher than par value, shares trading at a premium, or below, at a discount, which is unusual after listing. Issue price, price at which new shares are sold to the public, may be at par or at a premium. The Nigerian Exchange Group, NGX. Formerly called the Nigerian Stock Exchange, NSE. The NGX is the securities market where shares, bonds, and other financial instruments are bought and sold. Companies listed on the NGX include Dangote Cement plc, MTN Nigeria plc, GT Bank plc, Zenith Bank plc, Access Bank plc, Nigerian Breweries plc, Nestle Nigeria plc, FBN Holdings plc, etc. Benefits of going public, plc advantages. 1. Access to large capital, can raise enormous sums from public shareholders. 2. Enhance prestige and profile, being a listed company increases credibility. 3. Liquidity, shareholders can easily sell their shares on the stock exchange. 4. Growth and expansion, large capital enables expansion into new markets. 5. Employee schemes, can offer employee share ownership schemes. Disadvantages of PLC. 1. Complex formation, stricter regulation by SEC and NGX. 2. Loss of control, original owners may lose control as public shareholders have voting rights. 3. Expensive, flotation costs, legal, accounting, underwriting, are high. 4. Public disclosure, must publish detailed financial accounts, competitors can see financial position. 5. Short-term pressure, management may focus on short-term profits to satisfy shareholders and maintain share price. 6. Risk of hostile takeover, if share price falls, a competitor can buy up shares and take over the company. Remember, public limited company, PLC, equals incorporated plus separate legal entity plus limited liability plus can offer shares to general public plus shares listed and traded on stock exchange, name ends PLC, key differences PLC versus LTD, PLC equals unlimited shareholders plus shares offered to public plus freely traded, LTD equals 1-50 shareholders plus shares not to public plus transfer requires board approval, IPO/flotation equals first-time company sells shares to public equals must issue prospectus, filed with SEC, plus meet NGX listing requirements plus may use. Underwriters, shares, ordinary shares, most common equals true owners equals voting rights plus dividends not fixed plus last paid on winding up plus highest risk plus highest growth potential preference shares, fixed rate dividend paid before ordinary plus usually no voting plus paid before ordinary on winding up, cumulative equals unpaid dividends accumulate, NON cumulative equals unpaid dividends lost, convertible equals can convert to ordinary, redeemable equals company can buy back, participating equals also share in extra profits dividends equals payment to shareholders from profits equals decided by board plus approved at AGM, interim, paid during financial year, plus final, paid at year end after accounts, plus SCIP/bonus, additional shares instead of cash, plus property, assets dividend yield SAT face dividend per share/market price, x 100, share values, par/nominal equals face value in MOA, market value equals actual price on stock exchange, determined by supply and demand, plus premium if above par, issue price equals price at IPO, NGX, Nigerian Exchange Group, formerly NSE, equals where shares are bought and sold. Listed companies include Dangote Cement plus MTN Nigeria plus GT Bank plus Zenith Bank plus Access Bank plus Nestle Nigeria, PLC advantages, large capital plus prestige plus liquidity plus growth plus employee schemes, PLC disadvantages, complex formation plus loss of control plus expensive flotation plus public disclosure plus short-term pressure plus hostile takeover risk. Thank you and keep excelling at LightTech Academy, powered by LightTech Solutions Limited.